Welcome to this episode of Phillip Futures Market Watch. My name is Jonathan Chan and I'm an investment analyst with Phillip Futures. Today I'll be presenting to you the gold price outlook for 2017. Let's start with an overview. This episode is divided into two main sections. First, I will cover foreseeable gold price drivers, where I will explore geopolitical risks, a weaker US dollar, and negative real interest rates. After which I'll move on to develop my gold price forecast for 2017. Now I shall proceed to talk about foreseeable gold price drivers. As seen in last year's Brexit referendum and US presidential elections, gold serves as a hedge against geopolitical risks. In this section, I will discuss two sub-factors, which is US President Donald Trump and the future of the Eurozone. US President Trump has been in office for 3 weeks now. Other than the phenomenal fiscal stimulus that markets have been expecting since his election, two major points of uncertainty have arose. Firstly, the Muslim immigration ban have exposed rifts between the executive branch and the judicial branch of the US government. President Trump has attacked the rulings and neutrality of the courts. This may possibly give rise to further intra-governmental conflicts in the future. Secondly, the previous week's firing of National Security Advisor Michael Flynn has raised the probability that more of Trump's aides may have been communicating with Russian intelligence during the campaign and the transition period. Should further investigations be commissioned, and these allegations are eventually proven to be true, this may risk undermining the legacy of President Trump's election victory. Should the political situation deteriorate, this will serve as a bullish driver for gold prices. The next geopolitical risk is the future of the Eurozone. As we head into 2017 European election season, there runs the risk of more Brexit-like situations. The election calendar is as presented. Please note these election dates. Next month, the Netherlands kickstarts the election season on the 15th. Though it is only the 7th largest economy in the Eurozone, it may serve as a bellwether. France, the Eurozone's second largest economy, is next in Quarter 2. Moving on to Quarter 3, it will be Eurozone's largest economy, Germany's turn. Elections coupled with rising popularity of Eurosceptic views will lead to an increased probability that the Eurozone may further break up. Next, onto a weaker US dollar, a highly contrarian view in light of all these talks of a rate hike by the US Federal Reserve. President Trump's phenomenal fiscal stimulus should inevitably lead to massive government deficits. Greater government deficits will lead to a weaker US dollar. Foreign funding of this deficit is highly improbable given that President Trump wants to reduce trade deficits. Running trade deficits with trading partners is how these trading partners have the US dollar to be America's creditors. Given the prospects of less trade income with the US in the future under President Trump, two of America's largest creditors, China and Japan, have already started reducing their holdings of US treasuries. Domestically funding this additional government spending may actually derail the Federal Reserve's rate hike plan. As mentioned in the statements of several Fed officials, current rate hike plans have not factored in this additional government spending. The Federal Reserve may be forced by economic circumstances to keep their monetary policy loose to support this additional government spending. This would lead to a weaker US dollar and serve as another bullish driver for gold prices. Moving on to my last point of negative real interest rates. Real interest rates are negative when inflation is greater than the interest paid. This simply means that the purchasing power of your saving is being eroded by inflation. As has been seen in history, negative real interest rates have been the main drivers for gold price rallies in the longer term. This is illustrated in the price chart. From 1975 to 1980s period of negative real interest rate, gold prices spiked up by 19 times from US $35 to US $666. From the beginning of 2000 to now, the prolonged negative interest rate situation caused gold prices to spike up by 6.5 times from $272 to $1,770 at the peak. So should President Trump really increase government spending massively and the US Federal Reserve is forced to keep monetary policy loose to finance it, real interest rates are expected to stay negative or to become even more negative. These conditions will serve as a bullish driver for gold prices in the longer run. After having considered all these variables, it's time to come up with my gold price forecast for 2017. Given these three bullish factors of geopolitical risk, weaker US dollar, and negative real interest rates, my view is that gold price may retest the US 1,370 per ounce mark sometime this year. Here at Phillip Futures, we offer many different products for you to gain exposure to gold prices. For those looking for higher leverage products for shorter term trading opportunities, we offer OTC gold as well as gold futures listed on COMEX and TOCOM exchanges. For those looking for a minimum leverage investment product with a longer investment horizon, and for portfolio diversification purposes, we offer a new innovative product called Go Direct Investment. Do contact us at the following means if you are interested to find out more or to trade. We look forward to hearing from you. With this, I end this episode's Phillip Futures Market Watch. Thank you for your time, and we hope you will join us again next time. Until next time, my name is Jonathan Chan, and I'm an investment analyst with Phillip Futures. Goodbye.